Welcome back to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm really happy to have with me once again David McAlvany. David is the president of McAlvany Financial Companies, McAlvany Wealth Management, and ICA. That's a precious metals brokerage firm. He is a featured speaker in many venues, and he is a favorite of this show. He has a brilliant mind given to him by his creator, and he is using it in the service of countless people around the globe, which is why I'm always really happy to have him. Feel very blessed, actually, to have David with us to share his insights with my listeners. Thank you, David, for joining me again.
Thank you, Jay. Very generous introduction.
Well, it's a very accurate one, I believe, because I think you are doing a lot of things for a lot of people, starting with your family, by the way, and I know you are very much a family man. I might mention again to my listeners The International Legacy by David McAlvany, a book that's highly recommended by yours truly, not simply because it will help you in your financial life, but in your other walks of life as well. It's not just about making money. In fact, those of us, any of us who are just really focused only on that part of life are going to miss an awful lot of the good things that the Creator has given us to enjoy. So, David, before I get started, I just want to tell my listeners that I spent about 45 minutes this morning listening to your April 23rd McAlvany Weekly Commentary, and it was just fantastic. I think in explaining much about the financial world as it exists today, the global financial world, and helping us to understand the geopolitical tectonic fault lines that could lead us, I think, to some severe problems in the future. Certainly it's good to understand how the world really works as much as that's possible. So I hope that we might be able to touch on some of those issues that you talked about. And by the way, I think people can go back and listen to your weekly commentaries. Do they go to McAlvany.com or where would they go?
That's perfect. Yeah, McAlvany.com will link you to kind of our whole ecosystem. McAlvany Weekly Commentary is the URL for the commentary, but you can find everything at McAlvany.com. And last week, you're right, we spent some time talking about Iran and the reduction of oil intended to flow from there, or we don't want to see it flow from there. At least that's the Trump position.
Yeah, that's the Trump position. And, you say the other things, too. I'd just like to remind my listeners, also you have a quarterly tactical short strategy. That's a seminar, though it's a fairly long, I guess it's in printed form, but you can listen to it, and you need to sign up ahead of time to listen to it. Is that right? But people can listen to it. It's free?
Yeah, that's right. What we do with our wealth management products is on a quarterly basis, we have a conference call just to touch base with current investors and prospective investors who are trying to figure out how to have tactical short as a complement to their long portfolio. If they're working with professional money managers today, tactical short's a great complement to lower total portfolio risk. And our other wealth management products also have kind of that quarterly check-in, so you know what we're thinking and how we're likely to move in the next quarter.
Mm-hmm. And one more little blessing that I've just recently discovered that you provide there, your weekly recap, which is like a one-pager. Sort of, it's in a chart form. You can see most of the major markets that I'm caring about. You can see the movement from one week to the next, which I find very helpful for me. And I've been cutting and pasting that. I hope you don't mind, and passing it on to my subscribers on the weekend. But I'd really like people to go and avail themselves to all of the goodies, the valuable things that are available at the McAlvany site. Okay, so I've titled today's show, How Can We Thrive or Simply Survive Against ZIRP and NIRP? We've had Daniel DiMartino Booth on this show several times in the past. She was an advisor to Richard Fisher of the Dallas Fed. She was a big fan of Jerome Powell when he was named to the Fed, and somehow Danielle felt that Powell would do the right thing, do the hard thing, no matter what came his way, that he would stick with a move back towards normalization of interest rates, letting the markets decide them. And so she was surprised. I mean, I wasn't, frankly, but she said she was flummoxed by the Powell pivot early this year. Do you see any chance at all of central banks returning to a market-driven price of capital anytime soon, David? And what would it take for that to happen?
No, I think on a voluntary basis, it's impossible. And what we had was the big reveal going back to December and then that early week, January 4th. The timing of that U-turn was pretty critical because I think Powell saw for the first time how fragile the leveraged financial markets actually are. And even though philosophically he would like to take things back to sort of a market-driven environment, he's realizing that there is a cost, and I think he was looking into the underbelly of the financial market and seeing just how quickly it can be destroyed. So, I think what we saw there was a very telling piece, somebody who in principle would have supported market dynamics, and that U-turn suggests that he knows that there's a real issue, way too much leverage in the system, and it cannot be unwound without hurting too many important parties.
Yeah. Important parties is right. I mean, 2008, 2009, we saw that as well, I would argue. A lot of people that I know say, okay, QE1, but then we went to QE2 and QE3. It was just like too much cocaine or whatever.
Mm-hmm. Yeah, and I think we'll end up seeing more QE as time goes on. The fact that they're talking about lowering rates and maybe even, Nomura suggesting just in the last 24 hours that the first cut will be a 50 basis point cut out of the gate suggests that they really are concerned. Because again, when in history have they been this proactive in terms of getting out in front of a recession? Concha Lakota's comments a few weeks ago suggesting that this is how we need to manage the next recession. Long before it casts its shadow into the marketplace, we're going to be there to stop it. I mean, that's pretty radical talk, actually.
Well, it keeps getting more radical. Every bubble gets more, requires more radical solutions, it seems, quote-unquote solutions. Well, let's talk a little bit, David, or maybe you can help us understand what are the repercussions of this funny money, we're not allowed to have price discovery of capital any longer, it seems. And what are the repercussions to the economy, to society in general? Maybe you could not speculate, but give us your ideas about that.
Yeah, well, I think you're basically looking at a choosing of winners and losers, and the two tools that are being used as we move towards zero or negative interest rates as kind of a permanent state of affairs on a global basis is the two ways of extracting value quietly and surreptitiously: financial repression and inflation. And if you can manipulate the inflation statistic to a low level, a tolerable level, and then run the actual real world inflation number at a higher level, you are burning off debt at a quicker pace. So inflation is a tool. It's a very useful tool. Financial repression is. And in both cases, guess what? The losers are the savers and the middle class. The winners are those who are massively indebted. In this case, it's corporate America and it's your sovereigns who are under a lot of pressure should we see a rise in interest rates. So at this point, central banks have to be active in suppressing interest rates. That's where we get the financial repression piece. Yes, that hurts savers. Yes, that hurts those living on a fixed income. Yes, that hurts the middle class. And then, of course, inflation just absolutely guts the fish that we do call the middle class.
Mm-hmm. Yes, and we're seeing loads of inflation if you define inflation as the Austrian school of economics. It's simply the money supply, the massive amount of money that's created. And we have inflation, too, I would argue, David, as well, in the equity market and the financial assets, right? I mean, the bond market, for goodness sakes. The debt markets have just gone absolutely bananas.
Yeah, and that's right. If you look at from a valuation standpoint, you're talking about the stock market to let's say the capitalization of GDP being the second highest it's ever been in U.S. stock market history, affectionately known as the Buffett indicator. Cyclically adjusted price earnings ratio above 31. We've been higher. We've been higher, but only once in history. So yes, things are rich in the equity market and equally rich in the bond market. I had a conversation with the guru in the bond world, Mr. Sila, who wrote the book on interest rates. In 5,000 years of recorded history, what we're doing right now with interest rates has never been done. It's unprecedented. So again, what's on the other side of a low interest rate? It's a high bond price. Arguably, in 5,000 years, here in this time frame, 2016 to 2019, we've never seen bonds higher. Ever, 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 ever.
Wow. I mean, it's just hard to think about what's going to happen when the wheels finally come off this wagon. But It seems to me, we hear all the politicians talking about redistribution of wealth. We hear them talking about, we got to tax the rich or one thing or another. They don't seem to ever think about the fact that it's the monetary system that is responsible for this redistribution of wealth, do they?
No, that's right. And this is where they can get away almost with murder because people don't understand how this works. And, Trump is going to spend more than he brings in. That's the new way. It's actually not the new way. It's just being done at a level we've never seen before. Think about this, Jay. In 2002, we were in a recession, and we went in deep. We spent like drunken sailors, and we used money that we didn't have, all $158 billion that year. $158 billion in 2002. What about today? Well, we're not in a recession, and we're on track to spend $1.1 trillion more than we're bringing in. And if you look at Treasury issuance this year, it'll probably be an additional $400 billion on top of that. So what is this? It's monetary madness. We're soon to call it modern monetary theory, but Trump is already employing his version of MMT with issuing all kinds of credit and again, pressuring the Fed to make sure that between the Treasury and the Federal Reserve, it's just all kind of tidied up. And we have nothing to worry about in terms of the new exponential growth in debt.
David, do you see this playing out as some sort of a deflationary depression again? Because we have all this debt. I was talking to Michael Oliver earlier in the show today, and he's talking about how a lot of the measures of money, true money supply, or I don't know, some of the other measures are all down, and they're down worryingly to a lot of people who watch these things. I noticed that velocity of money is really, really down compared to what it's been. M2, I think, is the measure that the Fed uses. How do you see this thing playing out? What's the best guess, and how do you prepare for it?
I think this comes back to what we were talking about earlier in terms of being in the winner category or the loser category. Winners and losers are going to be politically chosen, and so there are going to be pockets of debt that are allowed to implode and go unsupported. And then there's going to be pockets which are absolutely sustained. A systemic deflation, I think you're going to see a huge fight to prevent it, but there will be areas where they just let it go. And so I would tend towards selective deflation in particular asset classes where you just can't hold the tide back. But the tools necessary to fight broader-based deflation are all inflationary in nature. And lest we forget, at the end of the day, all this is a confidence game. Everything is being played out in terms of, can you keep Joe and Susie Lunchbox engaged? Can you keep them happy and confident? And the day you lose Joe and Susie Lunchbox is the day it doesn't matter what the Fed tries to do, what the ECB tries to do, what the Bank of Japan tries to do. You're talking about a flood of money trying to exit some or maybe all of the markets that we now assume are going to be stable.
Mm-hmm. Sounds a little bit like China, Russia, other totalitarian regimes who pick winners and losers. But with regard to, so there might be some areas where they're not going to be protected. I'm guessing, for example, that the military-industrial complex will be protected. I would imagine things that are attached to government pretty closely will be protected. Private sector, people that don't have enough political clout will be left to go down. How do we know who to pick and who to choose? And is that something that you might be talking about from time to time, I'm sure, on your weekly commentary?
Absolutely. I mean, we're very interested in that. I think as you watch the groups like KKR and Carlyle, the very politically connected and very, very moneyed crowd, what you'll see is that the areas that are allowed to fail will be bought for pennies on the dollar by groups like Carlyle, KKR, and Blackstone. So I would be watching their acquisitive nature. I'd be watching where they move. And again, it's politically chosen winners and losers mean that somebody wins, even when there's a loser in the mix. I would look at private equity, again, to be a huge political winner as they clean up and are essentially allowed to step in and buy when there's blood in the streets.
All right, whichever way this goes, and I would like you to perhaps pass along to our listeners some of the services that McAlvany provides. You have a service where people can buy gold, buy and store it. I know that. What else do you do there that might be helpful to people of average means or above average means that might be able to help protect their families difficulty that we're going to be inevitably facing sometime.
I think one of the core things that people should focus on in this period of, trying to thrive in a ZIRP and NIRP environment where financial repression and inflation, I think, are a given. Precious metals aren't described as precious because of some marketing campaign. Mm-hmm. Gold has been that way for a long, long time, and I think you will see its value reemerge. But I would focus on how you construct a portfolio around the priorities of privacy and protection and profit. Privacy is something that we take for granted today. Maybe that's because we live in the 21st century and no one cares. But as governments become more and more invasive, I think, and who knows what we get in 2020, but privacy is going to be a priority as you're constructing a precious metals portfolio. Protection, I think, is kind of what we've been talking about. In the context of a devalued currency or inflation over time, I think gold is sitting right there. The profit component is one that I think is often overlooked because if you properly position a metals portfolio, you have lots of room for intra-market arbitrage. And I can give you a couple of examples, but we love things like the platinum to palladium ratio. Last time we did that for clients, we were able to capture an increase of 350% in ounces. It was absolutely fantastic. Another example would be something like junk silver. We've captured double-digit rates of return or increases in ounces since 2009. 3 different times we've captured an increase of ounces of greater than 20%. So I think who you're partnered with in that regard makes a difference. We've been in the business for 47 years and can certainly help construct a portfolio to focus on those 3 areas: privacy, protection, and profit. And again, I think that's where we work with a team that is second to none in the industry. At least I feel confident that they're that good.
Yeah, well, you've definitely have attracted some very strong people to your team, David. There's no doubt about that in my mind. And that's always important. People is everything when you're dealing, with almost anything in life. I would like to switch a little bit to some of the topics and some of the things you were talking about in your weekly commentary last week, in particular the petrodollar. Can you comment a bit about the petrodollar and why that was created to replace a global gold-backed currency that was in place until Nixon took gold away from money in 1971?
Yeah, and the petrodollar has a long history. It goes back to FDR in the 40s. Imagine being on a war footing and being willing to get on a boat, get over to Egypt, and spend some time negotiating something that was complementary to the Bretton Woods Monetary Agreement. So Bretton Woods is 44, and FDR's over in Egypt in 45, making sure that, who he was meeting with then was the Saudi royals, to make sure that the dollar would be traded in or the oil would be traded in dollar terms. Then you've got the Kissinger team in the 1970s, specifically 1974, the year I was born, did the same thing with the Saudi royals, really emphasized in the context of a dollar free fall. He knew that if there wasn't a wide audience of people holding, this is Kissinger was smart enough to figure this out. If there wasn't a broad base of holders of U.S. dollars required to hold those dollars so that they could be buying oil that they needed to run their economies, that was what stabilized the dollar. Free fall through the late 60s and early 70s. 74, you begin to see a floor put in. Pricing oil in dollars was again reaffirmed. The dollar was under massive attack up until William Simon made it over to the Middle East, representative of the Kissinger team. What is it today? I think we may see a similar version of that. With Iran being marginalized, what we're really doing is focusing the flows over back to the Saudis, a friend who's been with us for a long time. We totally pulled the rug out from underneath the Shah of Iran, in part because he wanted to prioritize Iranian interests, and we had U.S. domestic priorities that he was not particularly favorable to. The Saudis would play our game more than he would, so we put in the Ayatollah. Ever since then, we've been doing the same thing over and over again. We don't give two shekels for the folks in Iran, but we do care about the Saudis, and I think we just shifted a million to $1.4 million in production over to the Saudis. I think the quid pro quo may be we gave you a $75 million a day gift in terms of this oil flow. We need from you some financing of our treasuries, back to the petrodollar recycling that's been popular since the 70s, a way that we can finance our deficit. We mentioned it earlier, $1.1 trillion. Who's going to buy that stuff?
Right.
Who's going to buy that stuff? Because the Chinese are gone. The Chinese aren't doing it. They're not recycling trade dollars anymore. They were. We buy their stuff. They take our dollars and recycle them into U.S. treasuries. They're not real interested in doing that anymore. So we've got to kind of jumpstart that treasury purchases with petrodollars.
Yeah, and again, who's going to buy treasuries when the rates are where they are, right? They're just way below any kind of reasonable cost of capital rates. So,
except that relative to many other parts in the world, we end up looking like, almost high yield bonds. I mean, compare us to the Chinese or the Japanese. I saw that the president of the Swiss National Bank is arguing that 75 basis points below zero is not low enough. So, when we come in at 2 to 3%, we look pretty rich relative to a negative 75 basis points.
Yeah, well, we'll see where it goes from here once things start to fall apart in the U.S. economy. But, David, with just less than 4 minutes left, I'd like to ask you a little bit about how you see things playing out with China. I know part of the discussion that you had on your weekly commentary had to do with the flows from Iran. As you just said, we're trying to squeeze Iran. But there are willing buyers for Iranian oil, China, I believe. What about Russian oil going to China? And to what extent are those countries sort of seen as the evil nations because they don't play ball with our game, with our petrodollar game?
Yeah, I think there's some very interesting geopolitical undercurrents here. And, one of the things that we did is kind of up the pressure both on India as well as Turkey and China as well, because those were the three biggest buyers out of the 8 who had been exempted till May 1st. And they'll have to scramble and get their oil from someplace else. They can, they will. But again, we kind of unsettle them for a little bit. I think one of the things that plays very much to the Chinese favor in our kind of pushing them around, telling them what to do and threatening them with sanctions if they buy Iranian oil, is that they get to look very good to the Chinese people saying, wait a minute, we're not going to be pushed around. We'll do what we want to do. And anybody who tries. So remember, this is the anniversary of Tiananmen Square. And this is a great year to be whipping up sort of a nationalist fervor. My fear is that we can poke and prod with a stick a little too much, just as we did with the Japanese prior to the World War, where we started limiting the importation of the vital resources that the Japanese needed. And the unintended consequence was that the Japanese had to go to mainland China and start gathering resources elsewhere because we were cutting off their supply lines. So, and what we did was encourage the national fervor that the Japanese needed to get up and go and do that.
Yeah.
Could we do that again with the Chinese? Could we have failed to learn something from history? Could we have forgotten that poking someone with a sharp stick is generally not well received? It could have some unintended consequences for us. Unintended
consequences of dire unintended consequences, potentially, David. On that unhappy note, I think we're going to have to leave it go. But again, it's McAlvany.com, right? That's where people should go to follow all that you're doing.
You bet. From there, they can find our wealth management site. They can find our vaulted program, the gold savings program. They can find the weekly commentary, McAlvany.com, McAlvany.com. Look forward to getting to know you if you would like to have an extended conversation. Jay, thanks so much for having me on the program.
Thank you, David. Thank you for being with us.